Next, we're on to Chapter 14, Corporations. We're going to talk about retained earnings and income statements. I'm going to use the publisher's PowerPoints to get us started. So Chapter 14, just moving ahead here then. Owner's equity in a corporation, we talked about it in Chapter 13, is called shareholders' equity. There are two big components to that. Contributed capital, where you're going to see common and preferred shares, and then retained earnings. Owner's equity, again, is called shareholders' equity. And then just so you understand, let's go back here. In Chapter 13, we talked about contributed capital. That's, again, the shares, issuing shares, paying cash dividends. We're going to get into some different stuff here. And then the corporate balance sheet. Chapter 14, in contrast, talks about retained earnings and repurchasing shares, and then some different kinds of dividends, some stock dividends and something called stock splits. And we're going to spend more time looking at the corporate income statement, a little bit of time on there anyway. Now, retained earnings, just as a definition, carries the balance to the business's accumulated lifetime net income. In other words, how much profit it's had during its life, less any losses from operations, less any dividends. So make a bunch of money and maybe lose a little bit of money and then distribute some profits or some dividends. Whatever's left over is retained earnings. And if you distribute too much or you end up with a loss after you, with too many losses, if you end up with a debit balance in retained earnings, that's called deficit. Now, in retained earnings, there are credits to retained earnings, and that really only comes from net income. So credits increase retained earnings, and it increases because of net income. Retained earnings is not equivalent to cash. In other words, the profit that's left over might not be in cash. It might be tied up in some accounts receivable. Once you collect those accounts receivable, it'll be cash, but you don't always collect them on time. And the other side is you might have some cash tied up in or may owe some cash to somebody in accounts payable and in liabilities. So retained earnings does not mean that you have cash there as well. Now, ending retained earnings is a simple formula. The beginning balance, just like we saw in partner's capital, it's whatever the capital was to begin with. In this case, it's the retained earnings we had at the end of last year as the beginning balance. We add to it net income or deduct any net losses we have in the year, and we reduce it for any dividends that we have in the year. There's a couple of minor exceptions, but you're going to see about those later in the chapter. Now, when we declare dividends, there must be already a credit balance in retained earnings before and after you declare the dividends. So in other words, you've got to have some retained earnings in order to pay them out or to distribute them. And when you pay the dividend, the corporation's got to have the cash to pay the dividend, because that's what the shareholder's looking for. They're looking for their return on investment. They want some cash. Now, here's an example of some retained earnings. Okay, we'll have a beginning balance here of $70,000. We'll add the net income that we've had for profit. Usually we have one or the other. We usually have net income or a net loss. In this case, there's no loss. And then the dividends that we paid out. So the $50,000 comes out. So we end up with $100,000 left over in this case. Now, when we talk about stock dividends and stock splits, that's a little different. Let's talk about those things. We know about cash dividends, but here's stock dividends, or on rare occasions they're called share dividends. It's a distribution of the corporation's own shares to the shareholders. All that means is that instead of giving cash to someone, to a shareholder as a dividend, we're just going to give them more shares instead of giving them cash. And what happens is when we do that, the stock dividend increases common shares, so we have more common shares that have been issued, and we reduce retained earnings. Same sort of thing would happen if we issued common shares and then if we paid out cash dividends. So in which case, we're just shortcutting it here, just giving stock dividends instead of paying out cash dividends. And we end up, again, increasing common shares and decreasing retained earnings. It's interesting because it's just moving, it's a shell game. We're moving money between retained earnings and common shares, where it's not affecting any assets or liabilities. It's just sort of internal in terms of the shareholders' equity section. Now, here's an example. So we've got this company, Sugar Bay Parts, declares a 10% stock dividend on 75,000 outstanding shares. Market value is $1.50 a share. So the stock dividend is valued at $11,250, and you get that from the $1.50 a share times 7,500 shares, which is 10% of the 75,000 outstanding shares. So the effect on shareholders' equity, it should net to zero, but let's have a look here. So before, we had $100,000 worth of shares and retained earnings of $150 for a total of $250. After, we got the same, excuse me, $250, but we have more common shares because it's gone up by $11,250, and we've got less retained earnings. It's gone down by $11,250. It's just like a dividend's been paid, but popped into common shares instead. Now, we can continue dividends to do this. Like, the reason that we would do this is because we want to continue to pay dividends. We want our shareholders to know that we want them to stay invested in our company, but we want to conserve some cash. It's also a way of reducing the market price of the share of a stock. So, for example, if we had a number of shares and we issued a whole bunch more, well, it's still the same company. And it just what tends to happen is you have more shares sort of dividing the total equity of the company. That hasn't changed. So we basically are just have a whole bunch more shares available, or a bunch more shares available for the same amount of equity. Now, just with cash dividends, there's 3 key dates for stock dividends. Declaration date, so the date that the board announces the stock dividend. The date of record, in other words, the date that we figure out who owns what shares in the company. And then the distribution date, that's the actual date that we pay or distribute the stock to the shareholders. And again, it's usually based on the market value on the declaration date. So if we declare a stock dividend on April the 30th, then it's the market value of the share on April the 30th. That's the key in determining the amount that we're going to record the stock dividend at. Now, common stock dividends distributable is an account name. It's not a liability account. It actually shows up in the shareholders' equity section of the balance sheet. So if a company sets up its financial statements after the stock dividend has been declared, but before they actually issue it, then they set up the account common stock dividend distributable, and that's an account in the shareholders' equity section of the balance sheet. So here's an example. We got Tweeter Corporation declares a 10% common stock dividend November 17th, when the market value of the shares was $16. So that's the key date. It's the declaration date, and we know that the value is $16 a share. We know that the company will distribute 4,000 shares. It's a 10% dividend, and there's 40,000 shares outstanding at that point in time. And they're going to do that on December the 12th. So on the date of declaration, which is November the 17th, we debit retained earnings and we credit common stock dividend distributable. So the value being 4,000 shares at $16 a share. And what we've done is we've taken some of those retained earnings and distributed them, but we've got them set up in a common stock dividend distributable. So in other words, we haven't actually issued the shares yet, but we've said we're going to do it. Now, date of record, we don't actually do a journal entry. It's, again, just the date of declaration that we set it up, first of all. But we get a list of shareholders at that time who are going to receive the dividend. And that may sound a little different. Why are we doing it like that? Well, the reason we do it like that is because it does take a little while to determine who owns what, and we have to pick a particular date to determine who owns whatever shares. And then after that, on the distribution date, we actually issue the dividend shares to the individuals. And at that point, then we take and move the amount out of common stock dividend distributable, move it into common shares. So it's interesting, the impact on the shareholders' equity section before and after these dividends is nothing. It's still the same. We're just basically moving money from retained earnings to contributed capital. So in this case, you can see it's changed by 64,000. It's come out of, excuse me, it's come out of retained earnings, and it's gone into share capital. So, or contributed capital, pardon me. And those two terms, share capital and contributed capital, can be used interchangeably. So let's continue on here and just have a look. Stock splits are different. Now, a stock split is where we see the number of shares that are outstanding just increased. So this also usually results in a reduction in the market price per share, and it'll leave all the account balances unchanged. Nothing changes in terms of retained earnings or contributed capital. The only thing that changes is that the number of shares will change. So recording in a memorandum entry, sure, you can do that, but really there's no entry that needs to be recorded. Now, if we assume the market price here, we're just going to do an example here. We've got Mercado Corp it's got $100 market price, and there are 400,000 shares issued. The company wants to decrease the market price to $50 a share, so they decide to split the common shares 2 for 1. That's a very normal thing to do. If the price is too high and you want to bring it down, just so you can, maybe your price is too high in whatever you're doing. For example, Tesla shares at one point are trading at $731 a share. Well, there's very few people that can buy shares at $731 a share, or there are less people, let's say that. So if Tesla actually split their stock so you got 10 shares for 1, then the price should fall to $73 a share. So in this case, because they're splitting 2 for 1, the 400,000 shares that were originally issued now become 800,000 shares. Oh, let's go backwards here. Sure, let's go back to here. Okay, let's go there. Sure. Okay, we're out of line here. Let's get back here. So differences between stock splits. Hold on here a sec. Let's go back. So here's an example, again, carrying that forward, of what the shareholders' equity section looks like. In this case, before the 2 for 1 stock split, we just had $4 million in contributed capital and 1.8 in retained earnings. Same thing after the 2 for 1 stock split. The only thing is the issued and outstanding shares are 400,000 in this case before, and 800,000 afterwards. So continuing this on, let's go back one. Already got that one. Okay, let's try that. Oh, we're going to back it up. Hold on. Now we can do a couple of different things here, a consolidation or a reverse stock split. You can decrease the number of authorized and outstanding shares. What this usually does is it increases the market price. So again, if your shares were trading at $1 a share and you thought no, we want to be a $10 stock or something like that. Well, you can reverse split. In other words, exchange, every 10 shares for one new share sort of thing. And you'd end up with one share and probably a price that went from $1 to $10 on the stock market. So then if you look at sort of the similarities between stock dividends and stock splits, they both increase the number of shares for sure owned by the shareholder. Neither changes the investor's total cost. It's not cash, so it doesn't change anything. But both will increase the number of shares issued, and both will cause an increase in the number of shares, which will likely cause a decrease in the per share value. Now, stock splits themselves don't create taxable income. Stock dividends do create taxable income. So when we move that money from retained earnings to contributed capital, that creates tax for the shareholder because it's treated like dividend income and there's tax on dividends. Stock dividends in the shareholders equity section just move money again between retained earnings and contributed capital. Nothing changes in the total, but the book value per share will decrease because we've got more shares. Stock splits don't impact any of the account balances. So again, if there's $4 million in contributed capital, that doesn't change. That stays exactly the same. It's just the number of issued and outstanding shares that will change. All right, we'll go on to learning objective 2 in just a moment.